Digital signatures are used extensively in Bitcoin and blockchains for creating valid transactions and signing transaction messages to move coins from your account to another account. Digital signatures are a subset of electronic signatures, which can take a number of forms. A digital signature is mathematically linked to the content and to your private key. An example of a digital signature is as follows. So what is so special about a digital signature? Well, a digital signature is created by taking the message you want to sign and applying a mathematical formula with your private key. Anyone who knows your public key can mathematically verify the signature was generated by the holder of the associated private key, but without knowing the private key itself, which means anyone can independently validate that this piece of data was signed by the private key holder of this public key. So how is this better than your standard ink on paper signature? Well, the problem with a wet ink signature is that it is independent of the data that is being signed and creates two problems. Number one, there is no way of knowing if a document has been tampered after your signature is applied to the bottom. And number two, your signature can easily be copied and reused with other documents without your knowledge. In contrast, a digital signature is only valid for that exact piece of data. It cannot be copied and pasted underneath another piece of data. Others cannot reuse it for their own purposes. If the message was tampered, the signature will become invalid. The digital signature is a one-time proof that the person with the private key really did approve the exact message. No one else in the world can create the digital signature except you, unless that person has your private key. To bring all the concepts outlined in this lesson together, let's take a look at the process behind the digital signature. The mathematical process of signing a message with a private key is an encryption process. Taking the digital signature and decrypting it with the well-known public key and seeing that the decrypted signature matches the message being signed is the validation process. In most signing schemes, it is the hash of the message that is signed with the private key in order to produce a digital signature that is small in size, irrespective of the size of the data being signed. Digital signatures can be used to authenticate a transaction or message and to ensure data integrity of the message. It is not possible unless the private key has been stolen to say that the message was not sent by you. Digital signatures provide comfort for both parties to a transaction. They are used in blockchain transactions because they prove account ownership. The validity of a digital signature can be proven mathematically and offline without asking any other party. If you think back to our previous lesson, this is in contrast to a traditional bank payment. In a bank transfer, you first authenticate yourself by logging into the bank's website or showing your bank ID to the bank teller. Once the bank believes you are the account holder, the bank will execute your instructions on your behalf. In a blockchain system, where there is no central third party to provide or maintain accounts for you, your digital signatures are the critical piece of evidence that entitles you to make transactions.